Thanks. It has been wonderful. Last 2 days, and I am sitting between you and lunch. But thank you, Galaxy organizing team, for this wonderful opportunity. And I am among the panelists. See, this asset allocation, Siddharth and Karan made my job easy. They spoke on asset allocation. And most of us know about asset allocation. It is not that what we are going to do with asset allocation, which we are going to speak now. But whether asset allocation is really required in the long term. When you see the history around 1980s, this Brinson Hood and Bebover, that is what the charts which we have been reading for a long time. They said that that 93% of the time it is asset allocation which ensures that portfolio returns are better. This was a study which happened in US, and they said no, market timing is not relevant, or security selection is less relevant, but asset allocation. Then Vanguard study in 2017, they also re-emphasized that. But there are few things, as Babu asked, when you want to know show of hands, there are few people who wanted to say that in long term equities are far better. When 10 rupee NAV becomes 3,300 rupees NAV over a long period of time, why this asset allocation? This is something which is irrelevant. That thought also comes in. So let us know what panelists think about it and their thought. Let's start with Mohit.
Sure. Thank you, Ramki. Good afternoon, all the stars in the galaxy. And so I think Karan and Siddharth really made the job very easy. So they laid the foundation about asset allocation, and here is discussion. So I would like to use a very simple analogy for asset allocation. I think it is like the rear seat belts in a car, right? We know they exist, very few people use them, and we know they are meant for accidents. So why I'm saying this analogy, I think you will remember it for long, and certainly needed. I don't have any, I think there is a debate about it, that asset allocation is not needed. Second analogy again, because that makes life simpler. It's like picking up a winning cricket team. You have to have a balance of a batter, of a 4 combination batter or 5 combination of batters. You need a balance in the spin and a pace bowling attack, and of course you need all-rounders. So I will limit my comments there in terms of whether it's needed or needed. I don't think there's a debate about it. But yes, remember my analogy of rear seat belts in your car. Not many people use it, and we'll come to it later.
Yes, Devendra.
Okay, thank you IFA Galaxy for this opportunity. See, when it comes about analogies and it's about the asset allocation, my view is it is needed when it's not needed at all. Okay? It's like that safety net on that roller coaster ride of the equity, which is surely giving you an exhilarating experience, but it would make sure that you are there at the worst time. When the thrill is the most, it would not make, and the nervousness is the most, it will not make you jump out of the roller coaster for you to complete that ride. So if you have asset allocation, that's one of the safety nets, or you need to have MFDs like Padmanabhan and Vinod to help you along that for you to complete that ride, to actually have that exhilarating experience the roller coaster has to offer.
Fantastic. Yes, Rajesh.
Okay, good afternoon, everyone, and vanakkam. So, I'm sure. First thing, let me tell you, like sitting with Padmanabhan sir and talking about asset allocation is a very tough job. I am sure you all will agree that. However, I think when I heard the panelist name and I saw surname, I said I think we'll have to really prepare with the data to support the discussion. So yes, I think a lot of point already been shared with Karan, Siddharth on this topic, and I think Karan hit it one strong word of hard decision. Now, why I say that? Because as we all know that in this market, when small caps or micro caps are doing so fantastic, and the customers are ready to take a higher risk, right? Today, if you go and talk about the large cap, people say, no, tell me which are the more small and large and small and micro. So it's a very tough job to convince in this market asset allocation. However, I personally believe that it's very important. The reason why I say that, because I'm sure you know that any asset classes never moves in a similar tandem. Like they always, either gold will do well, or equity will do well, or maybe the bond will do well. If I ask one question from audience that, tell me which year, in last 10 years, all three asset classes outperform in double digit. Any guess? All three asset classes given double digit return in last 10 years. It was 2022. Even the bond has given double digit, equity has given double digit, even gold has given double digit. Or else in 2014 when the equity and the gold gave a better return. So what I personally believe, and I am in view, that as an advisor, as a MFD, my job is to ensure that the portfolio with a minimum risk can maximize the potential of returns, which is a very tough job. But I think asset allocation is very important for any portfolio, any advisor in this market. That's my view.
Yes, of course, when Rajesh gave that prelude, we'd like to hear from Padu too. Yeah. So let's hear from Padu.
First of all, thanks for the opportunity. See, the topic is asset allocation for the 20 years. So, asset allocation, it's a long term. Suppose we are driving for a very long journey. Most of the time, we will be traveling in a national highway. National highway, the minimum speed is 80 to 100. But most of the time, what we are doing, whenever we are driving in a city like Chennai, Bangalore, or Mumbai, it will be 40, 50 kilometers maximum. So, asset allocation can be okay if it is a 3 years, 5 years is fine. But when you are traveling for a very long drive, for me, there is no meaning of asset allocation because it's a long journey. Okay? And having said that, it's not easy, but you have to prepare your client mind. So most of the time, why we are recommending asset allocation? Because it's very difficult to control our client emotion. So he quoted about the roller coaster. See, if you take a roller coaster hardly, it will be for 3 to 5 minutes maximum. But everybody knows at the end of 5 minutes, you will be safe because all the safety measurements taken care. But the moment it started, at least 5% of the people are screaming like anything. The 95% are screaming with a lot of joy. So when the show over, 95% of people are very happy, 5% of the people are very scared. They will tell, I will never get into a roller coaster. So it is all about how you prepare the investor for a long term. So actually, if somebody follow asset allocation and other thing, Karan Datta could not retire at this age. Okay, so he made all the return because he is very, very aggressive on equity. So definitely, equity in the long run. In fact, equity is the least riskiest asset class in the long run. Thank you.
Equity least riskiest asset class in the long run. That has been, the powerful statement which you have. So we wanted how the audience, feel that, we did a poll. The poll came out like this: whether asset allocation is required in the long run. This is the thing. About 65, they participated in the poll. Some of you might have voted. 60 said yes, it is required in the long run. Okay, the question was still long run, and no was only 3. And some said, I don't know. But the next question, follow-up question, was even more beautiful. We asked, if at all, we are now looking at this thing, at what intervals we would like to do the asset allocation. Somebody said predetermined intervals, that is I'd say, monthly, quarterly kind of thing. Somebody said when market is good, then only we would like to, good or bad, then only we would like to make it. The percentage is almost equal. The predetermined interval is 27, and at market fluctuations it is 21, and no idea is about 11. So very, very different results for 2 questions. Mohit, can you throw some light on it?
No, I can confuse you further. So what happens generally in life, what we know we should be doing, we don't do. Be it on our health side, fitness, how we eat. Take it any walk of life. I'm overgeneralizing, and pardon me for that. But typically on a practical side, though, I'm leaning somewhere towards Mr. Padmanabhan, because hand on heart, it's so difficult to execute here. So difficult to execute. Ask how many, and put a hand on heart and say, how many of your investors would want to take out money right now and pay the 10% or 15% tax. The logical sense say, look here, let the market correct more than 15% or 10%. Should I be doing it or not? And me and you, unfortunately, do not have answers. I think answer lies somewhere how you start. On the very practical side, my belief is, and you can agree or disagree with me with the strong yes or no, first and foremost, to apply asset allocation, I should get the 100 rupee of the client, which we don't get here. Client gives us piecemeal money most of the time. There's 20 lakh of money invest, 50 lakh of rupees money invest, then how do I exercise asset allocation? My answer is, then the goal-based approach works the best. Because there we can probe the client, he or she can tell me. Because even people, Karan said short-term 10 years, I love him for that. Medium-term 20 years, long-term 40. But he's a big-time minority, you know it and I know it. I think goal-based investing, if you do, you can get some clarity where people can give some timeline to me and you, whether it is short-term, medium-term, long-term, and as distributors, you have a better handle there. You can advise on the range of products, which of course I'm not getting into. I hope I answered it
Some
somehow.
excellent thoughts. Mohit says that, we don't know the entire portfolio of the client. Then, whatever has come in, within that asset allocation means, it doesn't have that kind of relevant thing. Devender, can you throw more on light on that?
I disagree, honestly. I mean, while getting the whole client's portfolio could be a hindrance, but that doesn't take the merit of asset allocation out of it. Today, we have seen that even successful investors like Karan, who are being a role model for many of the people out there, he also mentioned about 30% going into guilds at the right time, right? So why not? And his time horizon is 10, 20 years, 40 years, which I totally agree. Today, the lifespan of an individual would be 85% plus. Most of us, some of us in this room would actually live 100 plus. Now, even though the expectancy is higher, the tenures are higher, it is always better to keep risk at the mind, risk awareness at the mind, at the back of the mind, because risk is always unforeseen. Even on the national highway, we have seen so many accidents happening where people, while 80 to 100 is the speed, people have crashed at 150, 200, even at 60 kilometers they have crashed at that. So risk management is always required, which is what asset allocation review is required on periodic intervals. You may act or not act depending on the situation, but I would say wear your seatbelts, keep reviewing, and keep the risk in mind always.
Devender takes that challenge. He's for clearly for that asset allocation, and he quotes Karan. Karan has displayed his success too. He said that 30% which came in that guild fund at right time had wonderful thoughts. Now this straight away comes to you that this 30% is relevant, right? So why not?
Yeah, multi-asset allocation fund, predominantly the debt oriented. So we had recently done that. Now, I just want to share some numbers on that, why the portfolio allocation is important. I know it's very difficult in this market to talk about any debt fund, right? But if you look at the 10-year historical mix, okay, I take simple 50% in the composite bond, 37% in equity, which is a Nifty 500, and 10 to 12% gold. This is the first combination. So we had done some study on that, and if you look at by doing this combination, if I would have remained for say 10 years, my returns somewhere between 10 to 11%, 10.4 roughly. Now somebody can say that why 37%, why not to 65% because my better off returns. Now if I do the combination of 65% equity, 25% debt and 10 to 12% in gold, the returns are around 12.5%. Now you see the risk. Now why the portfolio allocation is very important. Even I had increased my risk of equity, but my returns are very much stable. That is one part. 200 basis point. Now my next question here is that, see, we are as an advisor or think to minimize the risk and better the returns, not always to chase the returns. Because the same customer who is happy today, either 50%, 70%, yeah, 50%, probably if market falls, then probably he himself will come and say, why you have not advised this kind of allocation. So,
So This is a interesting thought again, 35% equity and 65% equity, both the things has given similar returns in the long run, but one has given lesser worries. One is to Padu, whether that lesser worries, or as Karan has said, advisor has also done some changes based on foreseeing the market conditions. How do you respond to that, Padu?
See, actually, it's all about how do you communicate to the client. See, I communicate to the clients. See, mutual fund investments are long term, okay, but not on the funds. The funds can change on a regular basis. See, the challenge with asset allocation means I don't have any conviction on anything. Very clearly told. And I wanted to please my investor because he is, whenever the market falls, he is angry or he shouted. So better we can do the cajoling and everything. I am very clear. I am not here to please you. I am here to tell you what exactly you want. So it requires a lot of guts and it requires a lot of efforts. Okay, and I feel that is what I am being paid. Say the kind of money what I am making is huge. Okay, I think no other profession can make this kind of money. So for that money, I have to do some justice. So asset allocation is very simple. We can live the life jolly, but I don't want that to happen. And say, for example, if you take kids, when they are focusing, whether it's an engineering or doctor, from their initial maybe formative years or in the elementary school or high school, the probability of becoming a doctor or engineer is very high. Most of the kids, they are not sure about anything. They hardly make into engineering or doctor. So the focus is, most of the people used to say, no, you should not talk about return, and we are in the profession of not a return management, risk management. Client is giving money after seeing everything to generate more return. Client is very clear. But we as an advisor, based on our surroundings and our conviction, we are only, because we are not ready to do all those things, we are putting a blaming that, I am in the business of generating return. I am not, in the generating of return, I am not taking undue risk. I keep telling what is the risk involved on a timely basis. Thank you.
Fantastic. So that Padu is very clear on this advisor alpha, and we are there definitely to provide that extra alpha. That's why we exist. And he also started with what is the communication. So we also had some clue from Karan's presentation. Karan, when he said in bull market how we should react with respect to asset allocation, and bear market what we should react with asset allocation. So how do we approach different cycles? Bull market, bear market, does it matter?
Ramki, a bull market and bear market definitely matter, but if with your due permission, I want to touch base on a slightly different route because I think Devendra others can pick on this question. I want to talk about the practice of the distributor here in the room, and maybe it's slightly divergent. I will take 2-3 minutes here. We're talking about asset allocation of the investor you manage. I'm saying about what is your practice. Because larger part is that we as the manufacturer side should be contributing and giving some thoughts here, how you increase your assets, how you increase your book of business. Look at the asset allocation at the country level broadly. If the overall assets in the bank are 200 lakh crore and we are 50 lakh crore as mutual fund, we are 25-75. Who is going to set this asset allocation right? I think some thought should be given here, and why I'm touching base this chord is, with your individual practice, what Mr. Padmanabhan is saying is absolutely correct. You at an individual level have to be extremely assertive with your client. How many of us do probe? We fear. You probe your client that what is your total book? I'm bringing back my old point back. You will be surprised how much money he or she is holding in bank fixed deposit. With a lot of politeness, keep that book in your comparison sheet. Start bringing that asset in the fold of mutual fund first. And wherein I would say on a very differentiated note, That can be your slightly assets or the funds that we have available in the industry today with 10% equity, 15% equity, 20% equity. Start bringing that book in your fold of business. I would say focus on that asset allocation at least. Client-based, I will again leave. It's very individual-centric. I am of the school of thought that we cannot generalize it. 35, 40, 60, 80% or some theory of PhDs doesn't work. It's absolutely individual-centric, what you do, but I will strongly urge, make strategies to bring in those bank deposits into your fold. I am very confidently saying that money should not go straight to an equity fund, wherein your book of asset allocation should set be right. Some numbers here, individual assets are 32 lakh crore in the industry, out of 50 odd lakh crores. Out of that 32 lakh crore, 27 lakh crore is equity, for your information. It's only fixed income is 4 lakh crore. I'm not recommending 4 lakh crore. Make it a hook to bring that client into your fold. That is also a version of asset allocation to me for your practice. I'm sorry I divulged.
Fantastic. So now 27 lakh crore equity size and 1:5 equity mutual fund versus bank things. Devender, I would like you to touch upon any mistake we as advisors do or even investors while educating the investors we do on asset allocation. So your thought on it.
See, it's not mistake. It's a decision which you take in the overall understanding of the client's portfolio which you have been shared. The efforts which needs to be, and he's right, that ideally an MFD or a financial advisor should be knowing the client's actual net worth, and that is when you can give a proper advice into where exactly things are being going. If you're looking for only for return generation and not for preservation mode, yes, client is always looking at returns and that is what he compares. You give him a nifty fund, mid-cap has done better, he'll compare you with mid-cap fund or a small-cap fund. The issue here is that you are wanting the client to navigate through this entire 10, 20 years journey, right? For that, you need to make the client aware that, boss, this is the risk, this is what you're going to go through. If not, then I'm not the right guy to be in. If you have advisors like him, I'm 100% sure the client's journey is going to be extremely well disciplined. For example, if you have a child getting born, start in small cap SIP. That's going to be the asset class which will not give you the best returns over the next 20, 25 years. You are not even bothered about it because you don't need that money. But there are various stages in person's life, so you need to keep reviewing those things. If you don't need the money, keep it going, keep it where it goes the best. Just make sure that you travel the entire journey and don't get stopped in between the way for you not to get those benefits.
Fantastic. So he also agrees that long term, we can even start with equity SIPs. Rajesh?
Yeah, thanks. Though on some points, yes, I do agree with Padmanabhan sir that I'm looking for the long term. But still, I, as a view that it all depends on the customer risk appetite again and his journey of the investment. So suppose if investor is young, yes, of course he is looking for very longer term, but the investor is retiree because I come from a retired family office, so as a family. So always they look at from how I'm looking for my monthly income and all those stuff. So I think here what I can say, both points are, I agree on Padhu sir also in a portfolio allocation. But still to conclude from my point of view, I look at that asset allocation is important overall. And one has to always look at in any market, either bull market or the bear market, because we had seen this industry some point giving a double digit in debt fund also. That scenario might not come, but we had seen that, right? Now equity is doing well, sometimes gold will do well. So I think it's important that time to time we look the portfolio with a minimized risk, and the asset allocation will help to generate and maintain the stability in the returns. That's my view.
Yeah. Padhu, anything on this bull market, bear market thing? You would like to put some thought on it?
Yeah. See, actually, not practicing asset allocation means, see, investor know how to invest in gold, real estate, fixed instrument. They are giving very, very small amount of money to the mutual fund distributor. And initially, they are not giving more money. They are just giving some share of money. When you do the asset allocation, then some money goes to their existing asset allocation itself. So that is one reason I am not in favor. And second thing, people, so whenever I am bullish or aggressive, so I am taking a very, because my aggression, I am just putting into my client portfolio. That is the comment I used to hear. See, the point is, I clearly communicated what is my style. Second thing, today we are in the advent of so many technologies. There is a Volt, you can do the lean marking. So what I assure my client, so whenever the market is going up, clients are comfortable taking the money because it is in the high value. But whenever the market is down, so you can take a loan against securities. See, because loan against securities hardly charging 10%. So the market delivers definitely in the next 5 years, 15%. If not 5 years, 6 years, 7 years, definitely it's worth taking money whenever the market is down, so that whenever the market is up, you can sell it. So you have the option to do this. So when you have the option, you go for a asset allocation. And if you want to differentiate it, see, here there are different people coming to this profession for a different need. Some people, they want to manage some, 25 crore, 50 crore. I was working someone, that time I was earning 50,000, 1 lakh rupees. Now I am my own boss, 1.5 lakh is fine. So I am not here for 1.5 lakhs or something. I want to create a huge, not for money, but I want to create a huge impact. To create a huge impact, for my mission, asset allocation has no meaning. Thank you.
Right. We need to be really. Yeah.
I would just like to add one thing here. While I agree and disagree to him, Japanese market has touched its all-time high again after 27 years. So you don't know when the market's gonna be up back again. So 5 years, 10 years, we have seen that in India happening again in a short span. The market comes back pretty quickly. But in a market like Japan, it took 27 years, and yesterday they caused an all-time high again. So asset allocation is important, risk management is important. While equities would give you the best returns over the longer term, you should have the appetite to just traverse the entire path with sanity.
Yeah, finally, if I'm few takeaways in less than 20 seconds. So we have.
I will take less than that. I'll take in cue from what Karan said. I'm giving you an acronym. It's called KISS. Keep it super simple, and that should be the formula for success.
I would say equities give you the best returns. Be it there if you can hold on to the water in your stomach being upside down.
Yeah, fantastic.
Okay, I would say only 2 words. The short-term stability and the long-term potential growth is very important.
Fantastic. Yeah.
Equity is the only asset class in the long term.
So, fantastic. Equity is only asset class. Most of them, they agree to be dynamic. As advisors, we need to create alpha. That is what the thing coming up. And I understand the overall investors portfolio. This is very, very important, because one portion alone we manage, and we need to be more nimble, and we need to be more responsible for our things. We need to create alpha. Thanks for this wonderful opportunity. Thanks for being here, and thanks for the audience.
Thank you, Ram.
Bye.
And can we have a big round of applause to all the panelists?